everybody. So I'm super excited. This is going to be the spiciest panel of the day. We have a number of really important topics to cover. We're going to cover finance. We're going to cover politics, religion. Sorry, that's Bitcoin. And markets. And we have like some scary, brilliant, and opinionated people here. So I'm going to go ahead and get started. We're going to start with something like, we have listened to a crazy ton of brilliant people today. And what I want to ask our panelists to do, and we'll start with Nick over there at the end, is help us separate the signal from the noise. What is the biggest problem or the critical thing that has to be solved for real world assets to fuel the next like super growth cycle? So let's start with that.
Do we count stablecoins in RWA?
Absolutely.
We have to find a reason to put things on chain that somehow makes it better than the traditional system. For stablecoins and tokenized treasuries, I think the answer is obvious, that it's a fundamentally more interoperable system, and it enables accessibility that we didn't have in the highly fragmented financial system. For equities and fixed income, there has to be some reason they go on chain. And I think it means developing like a full end-to-end capital markets infrastructure, as opposed to just putting these things on chain for the sake of it. So I would say we need an actual reason to do it. That's my answer.
Ryan?
I think stablecoins are probably the exception in terms of real world assets. So I agree with Nick. If you look at all the assets and all the sectors and innovations in crypto that have taken off, with the exception of stablecoins, they're all relatively new, right? So new digital gold, new pieces of intellectual property in the form of NFTs, new ways of issuing assets that are ultimately going to be, governance tokens that secure these decentralized systems, these open source systems. The last thing that you'll expect to see are equities and bonds and other, real world instruments that have pretty well functioning capital markets. And you throw in all the ambiguity and unclarity in the US, less so in Europe, but especially in the US, there's not really a path forward to actually get trillions of dollars worth of real world assets on chain. Now, I think over a long enough timeline, I think the infrastructure gets built out because of non-equities, non-bonds, kind of traditional real world assets. There's new types of assets that ultimately, I think, pave the way for all of this infrastructure. And then they'll end up coming last. So I think on a long enough timeline, our general thesis is that blockchains are just a new novel form of accounting, and ultimately the Venn diagram of what trades on a blockchain versus what is a real world it's not a Venn diagram, it's a circle. It's just a back end that is ultimately going to be improved and swapped out over the course of the next 20, 30 years with equities, bonds, and other real world assets outside of stablecoins probably being last.
Chuck?
Yeah, so it's tough to follow all those comments. But I guess I'd start with that. What we heard earlier today is that the logical place to me where this market starts to take off is in the highly liquid and kind of safe areas like treasury markets. But the real impact in the transformational markets is going to be on the back end around private markets and the ability to improve efficacy in those markets and kind of democratize access to those assets. And so I think we're going to be on this long pathway to that, whether that's 5, 10, 15 years, I don't know. But the impediment to reaching that point is policy formation. And when I say policy formation, I mean the combination of legislation and regulation. And I think that's where this panel and everyone in this room has an opportunity to help go to what Nick was just talking about, which is identifying the use cases and advocating for those. So I know that when I speak internally at my company or when I'm in Washington meeting with Congress, there's just a lack of understanding of the use cases, and to the extent that we can clarify and be ambassadors for those use cases with a clear purpose and outcome, then we'll start to get the traction to get to that transformation point of tokenizing private markets.
Okay, but let me play the role of congressman and say, okay, I don't really know what the value proposition here is. Like, we have a stock market, we have a bond market. So why are you all so excited about putting stocks and bonds on a blockchain? Like, can you not buy stocks and bonds some other way? What's the value proposition here?
Yeah, so that's exactly what they will ask, or certainly in the meetings I've been in. And I think it really goes down to the, one is showing the efficacy and efficiency potential in markets and how that translates into wealth creation and access to financial services for and underbanked segments of the population. And those segments of the population are also known as voters. So once that starts to happen, then there's, I think, a trickle up, to getting policy formation. But one of the things that I noticed in my last trip to Washington is they didn't really understand, and this was across both parties and both the Senate and the House, they didn't really see the clear use case, and they are not hearing from their voters, their constituents, that their constituents care. And so the combination of the two just leads to this kind of inertia. And at least one of those two things have to change, if not both, to unlock the inertia.
So actually, this is a perfect segue to, I think, the next question, right? The title of this panel is the macro view. So if we step back up to like 30,000, 50,000 feet, I feel like in a lot of discussion, we've forgotten what is the purpose of financial markets. The purpose of financial markets is to channel capital into productive uses. Now, in the last cycle, what we had was a lot of crypto money chasing a lot of crypto money. And I think if you were a politician, you'd be very reasonable to say, I am struggling to see the constructive value proposition of this. So, all of you guys tell me, and maybe we'll start with Ryan, tell me, like, what is the productive use of capital that is going to come from real-world assets? How are we going to actually make the world better and not just fuel another speculative frenzy?
I think my first answer, I'll reiterate a little bit. I think with the exception of stable coins, which are a really unique case, I'm probably the contrarian on this panel and at this conference. Sorry, I just don't really see a whole lot of real world asset adoption outside of some very kind of narrow slivers that are going to be massive in size and importance. But I think I worry that people might get a little bit ahead of themselves. This is not the first time. We call it something different every single cycle, but in 2015 it was blockchain, not Bitcoin, and then it was tokenized real estate and companies like Harbor and like the 2017, 2018 period, and that ultimately didn't really go anywhere. It's because most of those other asset classes, when you bring those assets onto the blockchain, they just don't work because they're already regulated. And so, all the benefits of a blockchain, instantaneous settlements, 24/7 availability, global availability, you're essentially hamstrung on the back end from whatever the laws are associated with a given asset or a given type of asset. So I'm bearish on a lot of these. I think, again, on a 15, 20-year timeline, I'm very bullish. But I'm not sure where outside of stable coins we're going to see huge tailwinds for adoption, because you're always going to have this dynamic where if it doesn't fit into a public policy framework and an equity that trades on the stock market does, right, you're not going to tokenize that share and have it legally trade anywhere. Maybe you will have a synthetic instrument that gives people an India exposure to US stocks. That was Mirror. The SEC went after them. But those two things I think are going to be in tension for a long time. And I don't really see this getting solved policy-wise in the next couple of years. Certainly not in this Congress going into the election in just 15 months.
Nick?
Yeah, there's a few things. So firstly, I think making dollars available to the entire global population as a bearer asset on your phone is immensely good, and will be probably the biggest contributor to human welfare this industry has ever done. And that's already the case, basically. So that alone is incredibly good. Tokenizing treasuries and giving effectively the risk-free rate, regardless of what you think the real prospects of treasuries are going forward, which may be somewhat dim, that's also quite good because historically access to the U.S. Treasury market has been only for U.S. individuals, and that's only 4% of the world's population. So that as well, I'm very excited about. Basically globalizing capital markets and externalizing property rights and yields that were previously only accessible to U.S. people or elites in these countries, and globalizing that, I think, is very strong. And then I think unleashing DeFi liquidity, primarily U.S.-based pools of liquidity for lending, especially for SMEs globally, in particular in emerging markets, is very strong. We saw this with microfinance and the kind of microfinance boom in the 2010s. That ran into problems. I mean, we're seeing issues with the underwriting for some of the lending protocols here, but I think that's also, basically just connecting global capital markets and reducing cost of capital for small businesses, in particular in emerging markets. I think that's also a pretty strong value proposition.
So, and by the way, that's enough, right? That like, if you digitize dollars and give the entire world access to yield-bearing instruments that represent dollar exposure, like that is enough. That's like in and of itself the most one of the most transformative innovations that you could think of for the global capital markets. So I think everything else, even if you're bullish on other certain smaller slivers of this market, or maybe disagree with me about the timing for other real world assets to take off, the reality is that's going to pale in, there's no comparison. It's orders of magnitude difference in terms of impact, and ultimately, I think in terms of product market fit, which we've seen. You actually tweeted this out. I think it's one of the most interesting charts in the last couple of years. Basically the unit of account for payments, and it's a chart of Bitcoin versus stable coins, and it's basically a hard fork. In terms of like stable coins and their ubiquity for payments versus Bitcoin, which is essentially now just digital gold and kind of this schmuck insurance in case the dollar collapses.
Hey, so I would maybe just take a step back to your question. And at the risk of being booed off the stage, I spent a couple of decades on Wall Street as a research analyst providing investment recommendations to institutional investors in credit markets. And so I know from my experience that in order to make a successful investment recommendation, you have to identify the catalysts that are going to cause the story to move, and then you have to be able to recognize when those catalysts have been put in motion. So it's actually fairly simple, but identifying those catalysts, and what's even harder is knowing when they've been put in motion. So when you extrapolate kind of that experience into this market, I think the catalyst has already been put in motion, which is, and it may sound odd to this room, but the application by BlackRock for the spot Bitcoin ETF, I think will look back 10 years from now with our 2020 hindsight, that was a pivotal moment when things started to move. And so I don't know how long it's going to take for that policy formation to happen, but when you get the world's largest asset manager legitimizing investment to RIAs and retail investors in the largest kind of investment community in the world, that is a catalyst, and it's been put in motion. And so then everything else is going to be kind of the second and third and fourth derivative from that.
So this brings us to something we've been circling around for quite a while, and it's time to get spicy. It's time to talk about religion. I mean, politics. And this is kind of the central issue, right? So you have a huge amount of innovation and activity going on, and you have at least a portion of the political ecosystem, especially here in the United States, that's basically saying like, stop, we don't want this, right? We're not happy with this. Are we going to have anything that approaches regulatory clarity in the near future? And if we're not, is it possible for this market to proceed without the United States?
It is. I mean, I was just in Hong Kong and Singapore and met with the regulators there, and they were very keen to impress upon me how serious they are about embracing the crypto space. I mean, Token 2049 had 10,000 attendees, and permissionless was a little quiet. I think the industry has recognized that the current status quo of the industry is outside of the US. I mean, we're increasingly doing deals outside the US. It's much more expensive and annoying to do that, so I wish I didn't have to. But that is the reality. The political signals in this country are incredibly hostile. And I think, frankly, if Biden stays in office through 2024, it'll be the same. Right now, it's basically the Supreme Court that's protecting us from the overreach from these administrative agencies that have gone haywire. And other jurisdictions have absolutely seized the initiative. I mean, Hong Kong is now pushing ahead with their regulation. They have a stablecoin regulation coming next year. Singapore is very seriously re-embracing the industry. You have places like Bermuda embracing the industry. Meanwhile, in the US, it's just total rejection of what's happening in crypto. So if need be, we will go offshore. I would hate to do that, but if need be, we will.
I would say a couple of things. One is that regulation can move forward in the absence of legislation, although it's a lot more difficult and can be a lot more spotty. You know, one of the great tragedies of the global financial crisis is that here in the US, we did not have a regulatory restructuring after the multiple failures of our regulatory structure that were put on show during the global financial crisis. So one of the elements that's going to ignite regulatory formation is a sense of global regulatory competition. And so I think the US regulators, and we say that as a term, but what are there, like half a dozen to 10 federal regulators, 50 state bank regulators, 50 state insurance regulators, multiple interagency organizations, and they all have a hand in policy formation and regulatory formation. So we are at a starting point in the global context of regulation formation at a serious disadvantage. And so probably the catalyst, or I think a catalyst that can prompt regulatory formation even in the absence of legislative formation is looking at, for instance, our big financial competitor in global markets, London versus New York. I think the UK, first of all, the UK has a much more streamlined regulatory structure than we have. And I think they actually, as a broad kind of entity, understand that the foundation of the next century is being laid right now. And so I think they have a real opportunity to kind of usurp the US and regulatory formation and crypto market formation. And that alone is probably enough to force action in the regulatory community in this country that pressure hasn't been there yet. So I think that will be a positive catalyst for regulatory formation.
Ryan, you're a part of, you run an analytics business. Do we see actual data showing that business is moving outside the United States?
Well, Token 2049 is 5 times bigger than the conference tomorrow, which is very frustrating to me personally. Yeah, that's one signal, right? To Nick's point, I mean, Singapore was hopping, and I think, you know, I saw a couple comments on the agenda that we have for tomorrow. I think it's timely, and I think it's the right conversation to have in the U.S. But there are a lot of policy conversations tomorrow, and I think if you look at the agenda at Token 2049, it's like, look at all the cool toys and look at all the, you know, innovations that have come out and been built during the bear market. And just the fact that, you know, we even have such a disproportionate focus right now on what's the SEC chair going to think of this? What's the CFTC chair going to think of this? How much is this going to cost to get these licenses in 50 states? How do we do this? How do we do? And the fact that, like, you know, basically, even if it's not explicit, the implicit reality in the US is every single time you move right now, when you're thinking about a product or anything business related, you have the little voice in the back of your head saying, what's my lawyer going to say about this? What's the regulator going to say about this? This is bullshit, right? Like, that's not how we became dominant as a country. It's not how we built, you know, the world's, you know, dominant financial services apparatus. And yeah, it's important that we should have guardrails and rules and consumer protections and things like that. But there's a big difference between that and where we are today, which is just regulators going rogue, lawmakers sitting on their hands because they're happy that the regulators are essentially squashing crypto innovation in the U.S. And you know, I'm pretty outspoken about this. I mean, if we have 4 more years of this, it's all going to be Singapore and Hong Kong.
So who's the most important regulator in the world, right? You know, Chuck, you talked about the UK as an important location, but the UK is not part of the European Union anymore. Is you know, MiCA, the Markets in Crypto Assets Law, takes effect next June. Is this going to be the catalyst that drives these markets forward? Is the Center of Innovation really going to move to Europe? Who's a regulator that is setting the pace around the world?
The only thing Europe innovates in is regulation. So, you know, they can have it.
Europe and innovation, I don't know about that in the same sentence. On your last question, though, one thing I wanted to say is the most obvious data point is stablecoins. So look at before FTX, onshore stablecoins were almost at parity with offshore stablecoins. FTX happened. The banking crisis here happened. What I call Operation Choke Point 2.0 happened over 2023. USDC sold off like crazy. Tether rallied. BUSD, which was actually an onshore stablecoin, in my opinion, sold off. The onshore stablecoin, as in the US market, was crushed. The people offshored their balance sheet. They fled the US. Their balance sheet went into Tether, like questionable Tether of all places. And now it's about 75-25. And in November of last year, we were almost at parity. So for me, that's the most clear signal. People are fleeing the US. They're completely offshoring their balance sheets.
I think that's a really interesting question in terms of like where the center of gravity is. And just like, I think there's in the US, there can be what I would think of as almost American arrogance that, okay, the financial, post-war era, the financial has been the center of all things financial and kind of the financial ecosystem, and New York and London kind of battling it out for who's got supremacy in euro markets versus kind of dollar markets and et cetera. But I think, when we talk about crypto and crypto finance broadly, one of the key tenets of the whole movement is globalization and being borderless. And there's really, in my opinion, no reason that just like we see markets moving from along a spectrum from centralized to decentralized, that financial hubs can't also be decentralized. And so there's, like every financial disclaimer is like the past is no indicator of the future. I will say that's also true kind of in this context. And when we were just in Singapore at Token 2049, had a great meeting at the Monetary Authority of Singapore, and I thought that was an example of a regulator really kind of on the cutting edge and doing all the right things, which is inviting financial institutions from around the world to come to Singapore and innovate. And these are American firms innovating with products in US dollars, but they're innovating in Singapore, not here.
So let's address a real possibility, which is that we could be looking at a future where the US dollar is the big global winner, but the US actually loses control of the dollar because much of it's being, all these countries can transact using, say, algorithmic stablecoins or dollar-pegged stablecoins that don't actually have dollars in them. Is that a real possibility that the dollar triumphs even though American companies and even US policymakers don't have any control over it?
That's already the status quo. Stablecoins are already tokenized Eurodollars. They're already majority issued offshore. The fact that in this country you can't have an interest-bearing stablecoin is going to further hinder the growth because we're going to see an explosion of interest-bearing stablecoins, and you won't be able to issue those out of the US. You see First Digital issuing their dollar stablecoin in Hong Kong. You see, I don't know whose mic that is. So, yeah, I mean, look, it's interesting that regulators globally have understood that people want dollars. 99% of all stablecoins reference the dollar. And so look at the Singapore regulation. They accept that it can be G10 currencies that are tokenized and turned into stablecoins. Hong Kong now also understanding it's dollars. So they acknowledge that people want dollars, but these dollars are outside the control, outside the aegis of the US. And this is only going to continue to be the case. You'll see stablecoins issued against crypto collateral. Like that's a new thing that we're seeing now. And the US doesn't have the choice to not have these things exist. They, sorry, one of you is rubbing the mic. Slow down. There you go. Good? The US doesn't have the choice to not have these things exist. They have the choice to have them exist in an unregulated, unaccountable way, or to exist here, and they're picking the wrong path.
Okay, I have so I was going to originally talk about markets here, but I think everybody's talked a lot about the fact that they think treasuries and other super liquid stuff is going to take off first. I want to have a separate question, which is one I didn't preview with any of you on, but one of the things that I struggle with is if you think about the world of crypto, people talk about trust, right? Everything that you need to know about a cryptocurrency, you can know from the blockchain itself. Everything that you need to know about a real world asset doesn't exist on chain. And if there's one thing that we've learned over the last few years, it's that when somebody who is issuing you a real world asset says, trust me, I have all these dollars or all this gold, you probably should not trust them, right? So how are we going to make a system work where all the really important information is off chain, and we can't all inspect every piece of data. We can't inspect every supplier. What is the systematic resolution that's going to make it possible for us to have actual trust in the transactions that we would like to be able to do? Otherwise, we're in a very high friction environment if you have to worry about the reputation or the capability of each individual participant who's issuing a real world asset.
I don't think you can have a scaled real-world asset ecosystem without a public policy framework, full stop. Because of that reason, right? Otherwise, it's just a series of black boxes. And I think we saw this numerous times in the past couple of years when you think about all the toxic collateral that had this domino effect across the ecosystem. I don't think that there's any reason to run back that market structure scenario from last year and pretend that that's not going to be an issue with real world assets as well. If we have these shadowy exchanges or asset issuers that aren't well regulated, real world assets. I mean, they're essentially like tried and true contracts that you're just using a new accounting ledger around. And so I think the only way that's you're going to realize any benefits whatsoever from these things trading on blockchains is if there's cohesion between the policy framework for those asset classes as they exist today, and then maybe you tweak those slightly to account for 24/7 trading and the ability to custody, and kind of move custodians seamlessly, or the dozen or so other kind of unique features that blockchains enable versus the legacy systems.
Well, this is what we need the S&P for, right? Or Messari. I mean, real talk though, it actually is a good set of.
So I know you're being a little bit tongue in cheek, but I mean, this is, as you know, this is originally
this was the original vision.
This was the original vision. Is how do you create like a first principles crypto Edgar? But the issue is if you are reliant on disclosures from a black box issuer or third party, they can just lie to you, right? So it's, without the rule of law, without like some enforcement mechanism there that has real bearing and is going to change someone's behavior, it's garbage in, garbage out.
Well, I'll say two things. First of all, there's a lot of firms that are working on the disclosure problem in crypto. Messari probably being the first and furthest along. But there's some really good ones. RWA.xyz, shout out to those guys. I really like what they're doing. I'm seeing new startups being started there, but the missing piece is, of course, the regulators in Congress need to create a disclosure framework, right? If they say these things are securities or security-like, we need pseudo-equities, maybe putting literal equity on chain. We need the opportunity to comply with that framework, but they have to create it for us.
I don't know if I've told this story publicly, but we know firsthand from folks in that office that Hester Peirce and her team took Reg SK and our 1.0 disclosures framework that we did back in 2018 at Messari. They had them side by side, and that was much of the backbone for the safe harbor. That safe harbor proposal has gathered dust for 5 years. We do not have serious institutions in this country. That's the problem. So if there are other jurisdictions that solve that, if you can get a regulatory framework in Singapore or Hong Kong or like some region where they come up with the equivalent of the safe harbor, which a lot of them are working on, that is where asset issuers will go, right? That's where innovators will go, because you'll actually be able to get this stuff out the door with reasonable requirements that you're not waiting 5 years, 10 years, however long we're going to end up waiting for any common sense regulations in this country.
Yeah, when you look at I said a minute ago that you look at a spectrum of markets from fully centralized, which is what we've had obviously historically, to fully decentralized. I think the fully decentralized is not even, you can't even see far enough to where that would even be possible. So we're going to be in this hybrid operating model for probably as long as people in this room are alive. Although I say that with the caveat because I tell my kids they're probably going to live to like 250, 300. So maybe I'll be wrong on that. But you know, so we're going to be in a hybrid operating model for a very long time. And the core tenets of trust and how those get kind of framed in regulation and it's going to be developing, and it's going to be a gray area for a long time. But that's not going to stop the movement and the development from the ecosystem advancing. So it will impede it and probably cause it to zigzag a lot more than what all of us in this room would like. But I think the march forward is going to happen undeniably, and then as the regulatory and policy frameworks get established, either by accident and then correcting or by pure insight, then that'll kind of just accelerate the path to a balance between centralized and decentralized markets.
But Paul, I just want to jump in real quick there because that kind of astounded me. So Chuck, you're saying that next 50 years in the US, we're going to be in a hybrid operating model? Fair statement?
Longer.
Okay.
Yeah, I just don't see, I think a pure decentralized is a pipe dream. Certainly in my lifetime. Now I'm older than everyone else up here. But I just don't see that as being a reality anytime soon, unless there's some technology advancements that completely and radically transform the very role of trust and kind of verification. Like that's the one caveat, and I wouldn't underestimate that. I think that's a possibility, but I don't see a time frame for that to happen.
All right, so we're almost at the close here, and I want to finish up. There's something that I talk to my team inside of EY a lot about, which is, yes, we are in a crypto winter. Winter is here. Actually, I think winter is over, and summer is coming. The question is, when is summer coming? And so this is kind of as a closing points for the panel, and we'll see if we have time for questions later. I want to know, at the macro level, considering all the uncertainty, the political risk, some of the opportunities, when do you think summer is coming, and what's going to be the catalyst for summer?
It's not coming for everyone.
I'm still waiting for a hot girl summer. I wasn't invited, and
we're not going to wag me. We're not all going to wag me. Okay, parts of this industry that have historically thrived will be dead forever, unfortunately, or maybe for the better. But yeah, we're not going to get the crazy token issuance that we had in years past. That's over. We're not going to get the crazy L1s, the venture funds putting $500 million into a new L1. That's done. We're not going back to that. We're not going to go back to yield farming, degenning. And that's not me saying I don't want us to go back there. I'm saying that's over. We're in a new liquidity environment, a new rates environment, new regulatory environment. Yes, parts of this thing are going to do great. Maybe we'll just get Bitcoin, Ether, and stable coins out of it. That'll be enough.
Me and Nick are fun at parties. Despite everything that we've just been talking about, Bitcoin is still at 27,000, right? Ether is still at 1,600. If we zoom out a little bit, I mean, a lot of folks in this room, it's probably split between how many years you've been around, but it is weird that there's a 4-year rhythm. I don't think that's going to persist forever, and I think if you're just following the astrological signs, you're probably going to have a bad time. But I do think that there's something to this kind of ebb and flow of the crypto market where we have these go-go days, a bunch of cool stuff gets built, and then we just have the vicious hangover. And then the folks that are left at this part of the cycle, they're the ones that kind of build for I think the next big cycle. So I agree with Nick that not everyone's going to make it. We don't necessarily know where the catalysts are going to come from, but that there's a lot of macro tailwinds that are only getting stronger, right? We have actual real inflation now in the country. We have stable coins that have clearly proven their product market fit. We have institutions that aren't necessarily coming, but that want to come in size. And they're basically just starting to kind of brute force their way in and maybe change the tenor of the conversation at some of the top regulators. You have different jurisdictions competing to be the hub for whatever the next cycle looks like. So you kind of have all these embers right now. And you don't really know when the wind is going to pick up, but it will eventually because there's just too much structural tailwinds, there's too much talent, and ultimately, I think sentiment is probably close to all-time lows in some respects. So that's usually a good time to back up the truck and get into the industry and whether you're an investor or builder, whatever, it's the time to really kind of separate yourself from the pack. So I know I've sounded like Will McAvoy for like the first 30 minutes here, but maybe I'll end on a positive note.
I would say that I would kind of look at summer as a nuanced season, kind of like a New York spring, I guess. But summer for the build out of capabilities in TradFi organizations, I think is here. There's a lot of investment happening to build capabilities, even if the regulatory and policy framework isn't in place to enable execution. But you see that happening whether you're looking in Singapore or Hong Kong or Switzerland or even continental Europe. So you see a kind of summer there. Summer in valuations is not here yet. Summer in valuations will follow kind of that development. So it's going to be a time frame.
Excellent. You heard it here first. Summer is coming. Thank you.